Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's generally going to be related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in there. Let's take a look and see what people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com is where you can sign up. And that's where I dive deeper into these topics, deeper into individual companies and how I'm playing this commodity bull market. And I do touch on the three pillars: it'd be market conditions, ratios, and uh, and technical analysis. So let's dive in here. Let's take a look. And we are starting off with FT commodities. So investors pile into platinum funds in a bet on hybrid vehicles. I didn't necessarily read this article. I didn't dive into it very much. It's not really what's important, in my opinion. What's important is that these things are going to start to show up, these news items. I already know the fundamentals of it in terms of hybrids consuming and having higher loadings of platinum group metals. That's rhodium, palladium, and platinum. It's all three of them. I also know that the companies are pulling back on production. We're talking about the monopoly companies, the big boys that control 60, 70% of the entire market. And when you get that combination where demand goes up and supply goes down, I think we'll have a good outcome. A lot of people say, when? When will it go up? What time exactly is this going to happen? And all I'm going to say is the charts look good. It looks like they are trying to put in bottoms. Some have been basing for a little while, like platinum. Rhodium looks like it's bottom. Palladium looks like it's trying to put in a bottom. And these things take time to round and turn, but they all look good. Even the individual companies look pretty good. And we're going to see more and more of these types of news come out as people sentiment change against the platinum group metal sector. We have Josh here, the value investor. He says if you sell quick for 10 to 15%, you have good income. If you hold for 500 to 1000% plus gains, you build wealth. I used to be a trader. I used to be in this area there. All I'm going to say is it's way better being here. You make far more money. You take on, in my opinion, less risk. There's less frustration and psychological things with it as well. So building wealth over time, yes, it may feel like it's slower, but if you're good at it, you move at warp speed. It's kind of like it's kind of like taking your time, but getting a first good outcome when you build something. If you build something, you try to do it quick, and you make something very messy, and it doesn't work. You have to take everything back apart and put it back all together again. That's what short-term investing feels like to me. It's frustrating. You get a lot of stuff wrong because in the short term, you're charting emotions. You're not charting anything that has to do with the fundamentals of really the sector or even the company itself. So it's more about charting the herd and trying to get the psychological herd correct than it is using psychology and the fundamentals and the ratios, which something's cheap. Combining everything is where you get your big bang for your buck. Um, Trading in the short term, people think they can do it, but I just hate to say it. No one is ultra wealthy that is a short term trader. All of the really, really rich people basically rode these asymmetry opportunities and had at least a good chunk in something that went up massively. A lot of the really rich people built businesses and held their stock for 20, 30, 40, 50 years. And they were just highly concentrated in a company that did incredibly well. They were founders, like Michael Dell, Bill Gates, Mark Zuckerberg, the Waltons, like basically everyone who's a multi-billionaire. They just held their stock and they kept holding it for very long periods of time. And I don't know why anyone else doesn't do what all the billionaires basically do. They buy businesses that are good and or create them, and then they just hold. And obviously, if we don't create the company, we have to have that staying power like they do, at least to some extent. Here's Grady. He says silver is in historical, long-awaited breakout mode. With gold's mega breakout 7 months ago, the PM bull resumed. Now silver's about to follow gold. He said for years that his minimum price target is $370 an ounce on silver. And it still is. There has truthfully never been a bigger opportunity or threat. So silver right now, it says trying to break out. We're basically breaking out in silver above that $30 level. We've already broken out on gold and it's running. So all these things are right ahead of us. The market conditions are completely ripe for gold and silver to rip it. And I am taking every single advantage of what I know today and the psychological and emotional traits that I've had to develop over all these years. I'm combining absolutely everything to take advantage of this. I'm going to hold through it. I'm going to ride, and I hope we get to somewhere in those levels based off of, I'll say, all my years of preparation for it. We got Dan here. He says, anyone under the age of 25 hasn't seen what's coming next for volatility in the markets. And, I was thinking about that. And it's like, yeah, these guys, they're very young, even people in, I would say, their early 30s. They haven't seen a big market pullback yet. They've only been in a recovery phase of real estate and kind of in an expansion phase. They've never had a huge pullback yet in tech stocks or the S&P 500. We had a little bit of a scare in the COVID scare, but I feel like that was an outside event that was forced on the markets. This time around, I do think that there's a little bit more like interest rates have a larger impact on this because last time interest rates barely moved, and then we had those problems in the market, and then they shut the economy down. But this one, we're going to get volatility, and obviously, I think we'll get even a bigger pullback, maybe 5 years from now or something like that. But um, a lot of young individuals haven't experienced these pullbacks, and they've gone head over fist buying crypto and technology stocks, and they're full believers in artificial intelligence, and I think all of that's in a bubble, and it could pop and really shake some of the beliefs in some of these younger individuals. And I tend to forget. It's like, man, these guys never really experienced anything. I went through 2008. I didn't think it was that bad, but I went through it. I know what it's like. I know what to expect, and I know time. You can always have time on your side and just ride on through it if you've got the emotional stability. I know a lot of people who, after the big market fall, crash, there's a lot of people at work that swapped all their money into stable market funds. And that's the exact opposite of what you wanted to do. You wanted to be in stable value to some degree and move it all back into the risky stuff after it crashed. So from a market psychology standpoint, I could see how a lot of people are just not prepared for a crash like that. And those were a lot of older individuals that that I remember doing that. RevCap says, not a big gold bug myself, but what if the dollar is about to weaken a lot with Fed cutting into an economy that's just fine? Now, that is a huge statement that what he just made here. He says, but what if the dollar is about to weaken a lot with the Fed cutting into an economy that is just fine? And you know what? I don't know if this economy is fine or not. There's certain metrics that look bad. There's other metrics that look good. We do have a yield curve that's inverted, but if they do cut interest rates, that'll probably uninvert the curve. But the uninversion of the curve isn't what causes the slowdown necessarily. What if we already went through the slowdown? Because, I mean, go look at commodities, go look at a lot of those areas, and they're already down off their highs 40, 50, 60% or more from the highs of 2021, 2022. So That's the most difficult thing. And I don't think anyone has that answer. I know people always try to find those answers, and it's like you won't know that until afterwards. It's only 2020 when you look backwards. So yeah, he says most big gold runs coincide with the dollar tanking, buying same amount of rocks and paper worth less, which is true. There's a lot of other sectors that go up a lot when the dollar goes down. Commodities are priced in dollars, so if the dollar declines, obviously commodities are going to do very well. But so will emerging markets and other currencies that do well against the dollar. They're all going to rip over that dollar weakening. It doesn't mean that it will be a straight line. Depending on how things fall and shift, sometimes there can be a sell everything liquidity event if things fall rapidly or quickly. Let's say the technology stocks fall rapidly or quickly, we could see the dollar decline, rates decline more rapidly, and we get a sell everything event, and then we get the turn. And in '02 was the big turn in commodities with a weakening dollar. Emerging markets did incredible things. So a lot of people try to time the short term, they try to avoid losses. But I don't think that's possible with everything. Like, I don't think anyone can time it. And even if they can partially time it, I would say that they were somewhat lucky, is what I'll say. Now, Michael Gayet, he says, what will it take for emerging markets to emerge? And I just made comments about it. It's going to be a weakening dollar. A weakening dollar is going to shoot emerging markets up. We've been going down with low interest rates in a recovery phase of real estate from '09. Emerging markets were really expensive. So we went from an expensive state to a cheap state. Every single time we've been at this cheap state, like in the late 60s here and in 99, 2000, we had these big run ups each time from these low levels. So now is a great time to look because I think that dollar is going to weaken. And the weakening dollar is going to strengthen the emerging market currencies. And that's what really drives it. Commodities will also go up, and a lot of emerging markets are very heavy in commodities too. And some of them, if you go back and look at history, some of the companies in emerging markets that were commodity producers went up 20 to 100x during this time when currencies, I think, will adjust a little bit here, probably within the next 6 months or a year. Kobayashi letter says, how did different commodities perform in the first half of 2024? Coffee prices saw the largest year-to-date gain, rising 21%, followed by silver, a gain of 19%. The third and fourth best performers were crude oil and gasoline at 13 and 12%. On the other hand, corn, wheat, and soybeans have declined the most by 18, 12%, and 11%. Overall, the Bloomberg Commodity Index gained 6% in the first half of 2024. Commodities are still fueling inflation. So there's the big outperformers. We've got crude oil down here too at 12%. We've got copper at 11, gold at 10, gas, oil, zinc, live cattle, lead, diesel, and then at the bottom, soft commodities: corn, wheat, soybean meal, wheat, soybean oil, cotton. I do think that this will, maybe not immediately, but in the future, I think some of these will move up and they'll cycle back and forth. So what I do is I try to take a pretty even portfolio between a lot of these, and then the I think the index will go up quite a bit when the dollar drops, and these guys will shift back and forth throughout the years. We've got Lawrence Leopard. He says, "Fix the money, fix the world." What a fantastic chart by Luke Roman. Let's go over this one. It says energy is excluded from the consumer price index because it's volatile. Yet, from 1861 to 1971, oil prices were remarkably steady when the USD was tied to gold. Energy only got too volatile when the USD's tie to gold was cut in 1971. Energy's volatility is a symptom of an inflationary symptom. It's a symptom of the value of the currency that it's being priced in. So this is the volatility when we have the gold standard. It was dead flat. And then after the gold standard, it was high and volatile oil prices as it cycles back and forth. What this is the real estate cycle cycling on, cycling off, cycling on, cycling off, and then we are in one cycling on. It's the value of the dollar dropping. And when interest rates drop, that's when the dollar drops. We're going to see, I think, big price moves in oil and commodities, emerging markets, and precious metals. And I think it's coming soon. Then we'll probably increase rates again, if you want my guess. Coming back over, we've got large amounts of money aren't made by buying what everybody likes. They're made by buying what everybody underestimates, according to Howard Marks. And that's kind of how I view my investments too, is I look forward and I say, what do people have wrong? And I still think that we are in an inflationary environment, and I think that oil is something that everybody has wrong. I don't think we can get off of it. I don't think electric vehicles are going to displace the amount of demand that people are expecting. I think there are a lot of barriers to electric vehicles being adopted in the size and quantity that people think. And even if certain countries adopt it, like the United States, and we really take on a large amount of electric vehicles, I still don't think that's enough to really dive bomb the demand for oil over the long time. I think oil is going to be with us, and we're going to use basically almost every drop that we can of it. So I think people are underestimating the demand for oil, and I also think they're overestimating potential supply of oil. And that's where I kind of meet in the middle because I think that's what's going to kind of hurt the system. And that's also why I'm very bullish on precious metals because the system's going to get hurt. It's going to be because I mean, if you think about it, if we try to adopt a renewable world, an electric vehicle world, it puts immense pressure on minerals, and all minerals are is a conversion of energy. And right now, it's just a conversion of diesel to metals, which is oil to metals. So really, metal demand is more or less oil demand. And I don't know if we can move that quickly to something else. So, Tavi, we are currently experiencing a multitude of technical breakouts in the precious metals industry. I can't recall a time when I've seen so many historical moves in this space. Here are my 6 favorite chart setups. So the first one is the gold and silver miners to gold ratio. That's starting to break that downtrend line. And that's the downtrend line that I call we need to break that for happiness for the gold and silver mining companies. We are doing that right now. This is a big deal. It's coming from an incredibly cheap valuation that I don't even know if it's ever been this cheap down here. Second, junior miners to gold ratio also breaking out from a 14-year downtrend line. So we're also seeing junior mining companies participating in this. They're starting to break their big downtrend lines. Number 3, the GDX ETF, or the most liquid gold mining stock ETF, also poked its head out of a 14-year resistance. We're breaking downtrend lines, guys. This is big. And the market conditions are ripe for this to occur. So we've got the full alignment here. The GDXJ ETF, which comprises of smaller junior companies, is forming a very bullish trend right now. 3 months above the long-term resistance line that we've broken out already. The juniors are playing the game too. This is a bull market, guys. 5, silver, which has likely been the most frustrating asset for investors over the past decades, is finally broken out decisively and appears to be heading towards its previous peak of $50 per ounce. And I think we are going to activate the bigger pattern, the 50-year pattern, 40 or 50-year pattern, which could activate all the way up to the multi-hundreds. And then number 6, the gold to silver ratio has also finally broke down from a 13-year support. This marks the beginning of a bull market in gold. Silver is likely to lead to the upside, and there's that downtrend or uptrend line breaking to the downward for silver. And that's all evidence of these things basically occurring. He says, while this thesis doesn't rely on technical analysis, it's always important when the macro and the fundamental thesis aligns with price behavior. Investors are far too pessimistic about this industry, and I totally agree with him. Far too pessimistic. We got Canadian oil rig count, new 5-year high for July. Meanwhile, US rig count is down 1. So in Canada, as weird as this sounds, guys, they're at a 5-year high. So here's the rig count. This is Western Canada gas rig count at 63. And then the Western Canada oil rig count is at 123. And then you can see the cycle. And this is going to new highs for the Western Canada oil rig count. It's coming. It's coming, and it's looking good. So Christine also says from 2011 to 14, the oil range traded between 90 to 110 a barrel. In inflation adjusted dollars, oil should be range trading between 124 and 150 a barrel today. $80 a barrel in 2011 is $120 a barrel today. If you don't see oil as cheap here, you have recency bias caused by shale oversupply, a global price war, then the COVID crash from 2015 to 2021. Another way that you can objectively say that oil is cheap is you can price it against gold. And when you price it against gold, it is incredibly cheap and it's real close to a 30-to-1 ratio, which I consider to be an incredibly good entry point. Finance guy, he was talking here. I wanted to share this here. He says, here are some of my options. This is for him. Buy a home for $600,000 and have a mortgage payment of $4,500 monthly, $100,000 down payment, $12,000 in closing costs, $11,000 yearly property tax. Rent a luxury apartment for $3,600 per month, a tennis court, a pool, and a gym. Both of these are 2-bedroom and 2-bathroom with 1,300 square feet of space located in similar areas. What would you do? Well, I don't know his situation. I don't know if this is all the money that he has. But one thing that I like is I like buying stuff and then staying in it for a long period of time. I don't want a $3,600 per month where I can get kicked out of something and I'm subject to increasing rent prices. So this here, whatever, if you choose this, you're guaranteed to pay more in the future renting. I don't know if there's anything that I've seen where the rent price has actually gone down. But looking at the home, you can always refinance. And refinancing means that you can lower your costs. So that is one option that you can have here. So I don't know what he's going to do, but what I have done is I've bought a house when I did, and I've locked in, and then I refinanced and locked in a lower interest rate for that. Says the probability of a recession has fallen to just 28%, the lowest odds since early 2022, which I find is kind of interesting with the yield curve kind of dropping here on us. This is jaw dropping from Katusa. He says more data is created in the last 3 years than in all of history. Explosive growth in data, and that's a 90x in just looks like 15 years from 2010 to 2025. 90x growth. Couple of more quotes. Recognize that psychology swings much more than fundamentals, and usually in the wrong direction or at the wrong time. Understand the importance of resisting those swings, and that's really what technical analysis is. And Howard Marks says, what are you doing playing the short term? Like resist the swings, invest, and go opposite. He says the most enduring advantages are psychological. Nick Sleep. John Arnold says will necessitate a large number of K to 12 schools and selective colleges to be closed in the coming decades. Males, and this is our demographics here. If you look real close, you can see how low we were in this bulge and how we went way up into almost the first-time homebuyers. First-time homebuyers, I think the average age is around 36. So when this moves to 36, which is like maybe a few more years, that will be the ultimate bulge. of the demographic. And even if this falls a little bit, you still have this big bulge that you have to get through. So I still think that we've got a couple more years of max bulge of first-time homebuyers. This also will correlate with affordability and family formation. All of it correlates together. Copper, the world would need 55% more copper mines to meet EV transition goals, says the study. And this is what I mean by hybrids being, I think, in more demand than what most people realize. Because the EVs, they just don't have the materials and the minerals to support such a large EV demand. Another dot-com bubble similarity, the S&P 500 has outperformed the equal-weighted S&P 500 by 13.4 percentage points over the last 6 months, the most since the 2000 dot-com bubble, and you can see the outperformance here. These occur at market tops. The breadth shrinks and concentration goes up, and we're very similar to that time frame, and this goes right in alignment with the 2000-2001 mid-cycle wobble that we experienced. Affordability of homes went down. We had a slowdown in the housing market. Housing starts started to turn over a little bit. When the slowdown hit the tech stocks and the stock market and the economy, they lowered interest rates, and then home prices and housing starts went to the upside. I think it's the same exact setup as the year 2000, 2001. First Majestic Silver, we got Keith in here. He says the silver deficits are growing. We're at 240 million ounces in silver deficits, which climb every year. With these deficits, we should be at $50 to $70 an ounce silver, says Keith Newmeyer. China's demographic decline is unprecedented. And look at the decline here, guys. So when you see this go down, and you see this bulge here in the 30s, that is what's causing the real estate crash, this decline right here. It's that move lower. They have smaller number of first-time homebuyers, and the housing market starts to collapse because there's too many homes for the amount of buyers that are out there. They go into a hyper supply phase. And that may not come back depending on what their demographic does. So they need a growing population to keep the housing prices elevated. Japan didn't have that, and their house prices continually fell, and they had problems with their economy and growing their economy. It's all demographic driven, in my opinion. So that's what I've got for today, guys. Give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we have that May Day coupon still active. We've got a question and answer session that is occurring today at 5 p.m. Mountain Time. So I'll see you there. And that's all I've got for today. So we'll catch you next time. This is Finding Value.